The New York market is tilting, not tipping. Heat is moving, pressure is easing, and the numbers tell a story of recalibration from Manhattan towers to Syracuse streets. Start with the pulse in October 2025. Across New York City, 2,191 homes went under contract, a jump of 10.4% from a year earlier. Contracts didn't just rise, they surged into autumn, leaping 29.4% from September to October, the strongest fall burst since 2021. At the same time, sellers stepped forward. Citywide, 3,539 homes were newly listed in October, up 18.2% year over year. The balance is changing. More choice for buyers, more discipline from sellers, and a market that holds its price line. The city's median asking price hovered at $1,050,000 in October, essentially flat compared with last year, while homes typically sold for 90 to 7.9% of their final asking price, leaving an average 2.1% discount on the table. But this is not a one-market story. Head north to central New York, and the shift feels different, quieter, but decisive. In the Syracuse area, as of October, the region had enough homes for sale to last 2.7 months at the current pace. That supply measure was up 30% from the same month a year earlier. New listings had climbed for 7 consecutive months by October, with monthly increases ranging from 4.2% to 19% in April. After years of bidding wars, cash offers, and waived inspections, once rare in central New York, pressure is finally easing. Sellers still have an edge on pristine homes, but the average percentage above list price has fallen for 8 straight months through October. What happened? Signals suggest 2 engines are turning at once. In the city, mortgage rates have been ticking down, just enough to stir buyers back into action and pull forward contracts in October. Across the state, more homeowners are willing to list, adding inventory without igniting a price breakout. And underneath the housing surface, the office economy is rewriting its rules. Nationally, office vacancy sat at 18.5% in November, only 90 basis points lower year over year, but coworking opened 22 million square feet in 2025, 16% more than the prior year. That expansion pushed coworking past a 2% share of the office market, up 30 basis points. Hybrid remains the dominant work model. 2/3 of firms allow location flexibility, and that has knock-on effects for where people buy, where they rent, and how long they stay put. Let's map the city first, borough by borough, and then connect it to the rest of New York's economic chessboard. Manhattan carried the most weight in October, with 1,060 homes entering contract, up 11.5% from last year. Half of the new listings citywide were in Manhattan, and it's the priciest third of that market that accelerated the most, with a 31.5% jump in deals. The median asking price in Manhattan landed near $1,456,254 in October, and properties spent a median of 75 days on market, an 18-day improvement from a year earlier. Some neighborhoods were fast and flexible at once. In the financial district, homes took an average of 80 to 7 days to enter contract in October, a striking compression from 160 to 8 days a year prior, while the median discount to the last asking price there was 3.9%. In Chelsea, sellers gave up a median of 3.1% off the last ask, with a median sale price of $1,365,000. Midtown East refined the curve farther, with typical discounts near 2.6% and a median price around $699,000. Brooklyn moved more cautiously. The borough ended October with 580 homes entering contract, a 2.4% dip versus last year, even as inventory thickened. Brooklyn added 1,006 new listings in October, a 17.5% jump. Buyers found leverage in some pockets. In Bay Ridge, homes carried a median discount of 2.7% from their last list price and a median sale of $694,900. Across Brooklyn, the median asking price held around $19.99, and properties took a median of 56 days to go under contract, 6 days longer than the prior year. Queens was the sleeper performer. October brought 396 homes into contract there, up 17.5% year over year, fueled in part by co-op-heavy areas like Forest Hills, Jackson Heights, and Rego Park. Queens' median asking price reached $674,700, while median days on market rose to 71, 16 days slower than last year, reflecting both deeper inventory and buyers taking their time. Underneath the sales tape is a steady geometry, more for sale supply, steadier pricing, and buyers negotiating at the margins rather than chasing runaway bids. Citywide, homes for sale totaled 17,243 in October, up 12.8% from a year earlier. Manhattan held 896 of those listings, an 11.9% rise. Brooklyn accounted for $4,239, up 11.2%. Queens had 3,009, up 14.1%. The rental market tells a parallel but not identical story. In October, the citywide median asking rent reached $3,950, up 8.2% year over year. But pause there. This is pleasant and professional voice to educate your audience. Inventory tightened. Homes for rent totaled 30 to 2,409 citywide in October, a 6.8% drop versus last year. Manhattan's rental inventory slipped 11.5% to 14,289. Brooklyn stood at 11,973, down 4%. Queens had 4,759, down 5.1%. Asking rents held at distinct levels. Manhattan at $4,600, Brooklyn at $3,752, up 7.2% year over year, and Queens at $3,200, up 6.7%. But incentives are back. In October, 23.5% of rentals across the city offered at least one concession, up 5 percentage points from last year. The Bronx led the way, with 43.2% of rentals including concessions, and it was the only borough to notch a year-over-year increase in rental inventory, up 24.4% thanks to new construction coming online. In Manhattan, 20.6% of rentals offered concessions, while Brooklyn's share climbed to 25.6%. More freebies and lower turnover, newly listed rentals fell 2.7% year over year, make a simple statement. Renters who can stay are staying, and newer buildings are cutting deals to fill up. The why behind the numbers starts outside the front door. Hybrid work has turned the office market from a temperature gauge into a pressure valve. In November, the national office listing rate averaged $30.77 per square foot, essentially flat year over year, even as vacancy held at 18.5%. New construction has thinned sharply. Only about 32.2 million square feet of office space was under construction as of November, a 44% drop from a year earlier. Yet Manhattan stood as an exception. In November, the borough recorded the highest year-to-date office sales in the country at nearly $7.30 billion, and properties traded at an average of $514 per square foot, almost triple the national sales average of $190 per square foot. Manhattan's pipeline neared 3 million square feet in November, and along with Boston's 4.1 million square feet, the two markets accounted for roughly 22% of the national office construction pipeline. If you zoom in, a new ecosystem appears. Coworking operators opened 20 to 2 million square feet in 2025, 16% higher than the year before. That pushed coworking's share of the office market past 2%, up 30 basis points. The reason is straightforward. The structured hybrid model has become the default for many employers, and flexible space fills the gap between fully remote and fixed long-term leases. Employment in office-using sectors slipped by 30,000 jobs in October, but over 12 months, those sectors still added about 188,000 positions, a 0.5% gain. The net effect is mixed: slower hiring, lower daily occupancy, but the momentum is not zero. Manhattan and Los Angeles now show some of the lowest vacancy rates among top office markets, underscoring that location and quality still command a premium. What does a co-working boom and a thinner construction pipeline mean for homes and apartments? It shapes where demand sits still and where it migrates. Flexible schedules let many New Yorkers stretch geography and time. In rental terms, this shows up as fewer moves. Again, newly listed rentals fell 2.7% citywide in October, tighter inventory in older buildings, and a rise in concessions concentrated in new developments eager to lease up. In for-sale terms, it looks like more measured bidding and sharper pricing strategies. Visibility matters. The most viewed listings in October sold for a median of 100% of their asking price, while the least viewed sold for a median of 96.7%. Now, roll back to Syracuse. The market there isn't just cooling off for buyers, it's repositioning for a new cycle. With supply at 2.7 months in October, up 35% year over year, and 7 straight months of rising new listings through October, the area is adding the one ingredient it lacked: time. Prices across central New York stayed higher than a year earlier in every month from November 2024 to October 2025, but what changed was the slope. The average percentage over list price fell for 8 consecutive months through October, a thermometer for bidding frenzy losing steam. Competition still spikes for immaculate homes, but not everywhere and not always. A voice from the ground drives the point home. A local agent with a 37-year career called this cellar-tilted stretch the longest he has seen. He expects 22.6 to be better for buyers than 22.4 and 22.5, an improvement measured more by options insanity than by falling prices. That expectation fits with 2 other facts on the horizon: a forecast that mortgage rates could move into the low 6% range next year, and a projection of home sales rising about 3% in 2026. There's also an assertion that wages could rise faster than home prices, which would gradually widen affordability, even if the latter rungs remain far apart for younger buyers. There's another spark. Syracuse has been named among the housing markets most likely to heat up in 26X, alongside places like Cleveland, St. Louis, Minneapolis, and Madison, as well as suburbs around New York City. The logic centers on affordability and risk. The Midwest and Great Lakes have stayed relatively affordable through the pandemic-era price run-up and are seen as safer from climate-related disasters like wildfires and floods. At the same time, some of the markets expected to cool. Nashville, San Antonio, Austin, Fort Lauderdale, West Palm Beach, and Miami face pressure from natural disasters and rising insurance costs, with an added twist as remote workers return closer to offices. In that kind of map, central New York looks like a port in a storm. One projection puts Syracuse home prices up 12.4% next year, the largest increase among New York locations in that outlook, while buyer conditions locally still look set to ease thanks to more inventory and fewer above-list outcomes. Back in the city, the rental chessboard is moving one square at a time. Manhattan's median asking rent held at $4,600 in October. Brooklyn's reached $3,752, up 7.2% year over year. Queens came in at $3,200, up 6.7%. Citywide, 18.1% of rentals saw price cuts in October. In Manhattan, that share was 23.7%. In Brooklyn and Queens, price cuts touched 14.6% and 14.5% respectively. Yet the more telling stat is concessions. The Bronx's 43.2% share of concessions highlights how new construction can redirect pressure. It is also the only borough where rental inventory increased year over year, up 24.4%, suggesting that the pipeline of new buildings there is helping to absorb demand that isn't being met in older stock. For buyers, the city's sales details matter at the micro level. Manhattan, driven by luxury at the top third, still sets the tempo, but pricing isn't reckless. Homes sold for 97.9% of last ask in October, and the median asking price stayed flat citywide at $1,050,000. In neighborhoods with higher asking prices like the Financial District and Chelsea, sellers accepted median discounts of 3.9% and 3.1%, respectively. In Brooklyn's Bedford-Stuyvesant, the median sale-to-list ratio was 90 to 6.4%, meaning half the homes sold with more than a 4% discount. It's not uniform, but it's disciplined. Queens, with surging contracts and slower days on market, shows that buyers are combining patience with precision, using a broader inventory base to negotiate timing as much as price. The office market underscores how these local dynamics are part of a larger structural shift. Consider Manhattan's position in November: $7.30 billion in year-to-date office sales, closing at an average price of $514 per square foot. Listing rates in Manhattan averaged roughly $68 per square foot in November, the highest in the Northeast. Meanwhile, Boston's office pipeline sat at just over 4.1 million square feet, Manhattan's at close to 3 million, and together they represented 22% of the country's roughly 32 million square feet under construction. It's a shrinking pipeline, down $40.40 from a year earlier nationally, but concentrated in markets with durable demand. That concentration means New York City's office sector, still facing lower physical occupancy than before the pandemic, may lean even harder on flexible space as businesses test smaller footprints. Coworking's 22 million square feet opened this year is less a fad than a bridge. As that bridge holds, renter mobility slows, owner churn normalizes, and sellers price for reality rather than fantasy. In the Midwest, a different equation is visible through the office lens. Chicago's average year-to-date office sale price clocked in at $64 per square foot through November, nearly 28% below last year and the lowest among top markets analyzed. The Twin Cities sat near a 17.8% vacancy rate in November, better than the national average. Yet, even there, consolidation by a major tenant into a single building put visible pressure on occupancy. Those are office stories, but they feed housing decisions. When high-priced job centers like Manhattan display resilience, lower vacancy among top markets, and premium pricing, proximity to that engine still matters, including in the suburbs around New York City, flagged for momentum in 2026. For central New York households making long plans, the math is straightforward but not simple. New listings rising for 7 consecutive months through October expands choices. A supply of 2.7 months, up 35% year over year, cuts waiting times and tempers overbidding. The average premium over list falling for 8 straight months through October removes some of the adrenaline from offers. Yet price levels remain higher than a year ago each month from November 2024 to October 2025. The coming year's projected 12.4% price growth suggests that buyers will find a clearer path to transact, even as the sticker price moves up. A paradox that only makes sense if lower competition and more time on market allow thorough negotiation and careful selection. Zoom back to the city. Citywide median days on market held steady at 68 in October. Manhattan's improvement to 75 days, a shift of 18 days faster than last year, speaks to a buyer pool galvanized by rate relief and a seller pool pricing to meet them. Brooklyn's median of 56 days, slightly slower by 6 days, and Queens' 71 days, 16 days slower, show where inventory is offering buyers more time to compare. Across all boroughs, the iron law is visibility. The top fifth of listings by views sold for a median of 100% of their asking price in October. The bottom fifth sold for 96.7%. In a market with 17,243 homes for sale, strategy is data and presentation as much as number. The rental layer adds new texture to affordability. With 409 homes for rent in October across the city, down 6.8% year over year, the biggest levers for renters are timing and concessions. Citywide, 23.5% of rentals offered a free month or similar sweetener in October. In Manhattan, 1 in 5 rentals offered concessions, even as the median asking rent held at $4,600. In Brooklyn, more than a quarter offered concessions, against a median ask of $3,752. In Queens, where the median ask was $3,200, 21.9% of rentals included concessions. Add in that price cuts appeared on 18.1% of citywide rentals, 23.7% in Manhattan, and the map for renters becomes a game of overlapping circles. Newly built buildings with offer stacks in the Bronx, older Manhattan stock with targeted reductions, and borough alternatives where total cost can be brought down with timing. The ripple effects travel beyond monthly payments. When newly listed rentals fell 2.7% in October, it signaled a broader caution. Renters who can lock in stability often will, particularly as job growth slows in office-using sectors and the cost of moving stays high. That reluctance to churn keeps older buildings tight and incentivizes developers to attract tenants with concessions in neighborhoods where new construction tilts the balance. As the Bronx's 24.4% increase in rental inventory shows, affordability can improve on the margin without pulling headline rent levels down everywhere else. So what comes next? Build a baseline for 2026 with the numbers at hand. Buyer activity looks sustained as mortgage rates are expected to move into the low 6% range. A 3% increase in home sales next year is on the table, helped by more homes for sale and sellers who are pricing to clear. In New York City, that likely translates into continued stability around a citywide median asking price near $1,050,000, a sale-to-list ratio anchored around 90% and borough-by-borough negotiation bands from roughly 2 to 4% depending on the micro-market. In rentals, rents should remain elevated but tempered by incentives, especially in areas with new supply. With 23.5% of rentals citywide offering concessions in October, a high teens to mid-20s share through the first half of the year would be consistent with a market using deal structures to balance demand. In central New York, buyer conditions should keep improving even if prices rise, because the relief is in the mechanics: longer shelves, shorter lines, not just in the stickers. Watch two things between January and June. First, mortgage rate trajectory and its pass-through to contracts. In October, contracts jumped 10.4% year-over-year citywide and rose 29.4% month-to-month. If rates edge into the low 6% range, contracts should hold that momentum into spring. If they stall, expect the contract pace to soften and days on market to lengthen in Brooklyn and Queens, where buyers already show patience. Second, the flow of concessions relative to rental inventory. In October, 23.5% of rentals offered concessions citywide, and Bronx rental inventory climbed 24.4% year-over-year. If concessions stay elevated while rental inventory remains tight in Manhattan, down 11.5% year-over-year, expect renters to continue trading neighborhood and building age for deal value, keeping turnover suppressed, and deepening the split between new and old stock. There are risks. If office-using employment weakens beyond October's 30,000 job decline and stays flat or negative through the first half, the city could see more cautious buyer behavior and a slower rental churn, with concessions doing even more of the heavy lifting. If rising insurance costs accelerate out-migration from coastal markets expected to cool, places like Miami, West Palm Beach, Fort Lauderdale, Austin, and San Antonio, demand could surprise to the upside in markets seen as safer from climate disasters. That would add fuel to the projection that Syracuse and the suburbs around New York City will heat up in 2026 and could lift prices beyond the 12.4% increase expected for Syracuse next year. And there is upside. Manhattan's office ecosystem, even at lower physical occupancy, is showing premium pricing, listing rates around $60 per square foot in November and year-to-date sales averaging $514 per square foot. With a pipeline near 3 million square feet and coworking gaining 22 million square feet this year, flexibility is becoming infrastructure. If that infrastructure pulls more firms back into growth mode by mid-year, expect hiring to stabilize and high-end housing demand to remain firm, particularly in Manhattan's top third price tier, where sales rose 30 to 1.5% in October. That would uphold the current pattern: disciplined pricing, fast-moving, well-marketed listings, and a city where the highest visibility homes still sell at full ask. Through all of it, Syracuse's numbers are the quiet heartbeat of a different New York. 7 straight months of rising new listings through October. 2.7 months of supply, up 35% year-over-year. 8 straight months of shrinking premiums over list. An expectation of price gains of 12.4% next year. Those metrics don't show a cold market. They show a market rebalancing. Slower, clearer, easier to navigate, even as values climb. For families who lost out in bidding wars in 24 or sat out 2025 as inspections vanished, 2026 looks less like a wall and more like a door. New York City, by contrast, remains a study in tension. In October, 17,243 homes were for sale, up 12.8% year over year, yet homes still sold for nearly 98% of ask. Manhattan's rental inventory dropped 11.5% to 14,289, yet more than 1 in 5 rentals included concessions. Brooklyn added 1,006 new listings, up 17.5%, yet contracts dipped 2.4%. Queens lifted contracts by 17.5%, but stretched days on market by 16 days. The whole picture reads like a market that's learned to breathe through its nose. No rush, no panic, just the steady transfer of homes from sellers who price well to buyers who look harder and move faster when they find the right fit. The office spine sustains that cadence. Nationally, vacancy at 18.5% in November, and a pipeline that shrank 44% year over year tell you supply is being withheld until demand proves itself. Manhattan's $7.30 billion in year-to-date office sales, highest in the country through November, tell you that proof is arriving in selective places. As hybrid remains the default, coworking fills the space between worlds. 20% square feet opened this year, 16% more than last. That's not a side note. It's the architecture of an economy that will buy and rent differently and for longer than it did before 2020. In that architecture, 2 New Yorks move together, one dense and vertical, one spacious and steady. Both are resetting, both are negotiating, and both are teaching the same lesson. Markets don't need to fall to become fairer. They need time, clarity, and depth. October and November gave us each in measure 2,191 contracts and 3,539 new listings in the city, 2.7 months of supply and 7 straight months of new listing gains in Syracuse, $7.30 billion in office sales in Manhattan, and $514 per square foot on average. A citywide median rent of $3,950 with 23.5% of rentals offering concessions, and a Bronx rental inventory up 24.4% with 43.2% of rentals sweetening the deal. By the time spring arrives, that measurement will either hold or break. The base case holds, rates near the low sixes, contracts humming, concessions steady, and a 3% climb in home sales in 26. The risks to watch are clear. Office hiring softness dragging on demand, and climate and insurance forces reallocating it. This is our actual pleasure, for the story continues. The story continues. If they intensify, the map redraws faster. For now, the reset is underway. If you want the signal without the noise, stay close. We'll keep tracking the numbers that matter.